Greetings to all investors, my name is Václav, and today I want to take a look at Duolingo, which has fallen by 56% over the past year. And there are a few reasons for this. The company, let's face it, was heavily overpriced in 2025. Investors who were afraid of competition from artificial intelligence and companies such as Google and Meta, who are creating their own language translators, pushed the price down from $500 all the way to $156. Today we will analyze Duolingo and we will find out if the company is now undervalued and if it would be a good idea to add it to our portfolios. Our analysis, as always, starts with the business analysis because before we invest in a company, we always want to know how the company works, what its future potential is, etc. First of all, let's look at the market share analysis. Duolingo is in a quite competitive sector, but it can still maintain a leading position in the global market. And there are two reasons for this. The first is that Duolingo offers free versions, and these free versions are very similar to the paid version, but sometimes there is an advertisement. The second and the main reason is that a lot of people don't want to actually spend hours on learning a language, reading text, memorizing words, etc. A lot of people would spend the time by having fun, but they want to feel like they don't waste that time. So they are learning a language through Duolingo, which is fun and is made as a game. These people don't really want to learn the language, they don't need it. They want to feel good that they are doing something useful that they enjoy. And I hope I don't offend anyone now. I have Duolingo myself and I use it daily. If someone needs to learn a language for real, they probably won't use Duolingo for that. But there are very few people like this and Duolingo is heavy on everyone else. That's why they have a leading position. They don't care about the 5% of people who want to learn a language, but they care about the 95% of people who want to spend time in a fun way. Because of this, we have to evaluate the market share as an A, because Duolingo found a hole in the market and they are fully using it. Next, I want to look at innovations. What's great about Duolingo is that they have a lot of space for innovation. They don't just have to stick to learning languages, but they can get into teaching mathematics or music or maybe chess, which they most recently started doing. They found a hole in the market and are now expanding horizontally. Duolingo also uses artificial intelligence a lot, and a lot of investors or a lot of people think that artificial intelligence will run Duolingo over, but Duolingo is in the best position to use AI. The same as Google. A lot of people think that Google will get run over by AI, but Google is in the best position to use artificial intelligence for its benefit. It's the same as Duolingo. Duolingo has a lot of data from users, the most data actually in the world about language learning, and they can use this data to train artificial intelligence and use it in their product to improve it, attract more people, and thus generate more revenue. With regard to their position, we will also have to evaluate innovation as an A. And now we move to the final stage in the business analysis, and that is the product demand section. There are about 8 billion people on Earth today, and a lot of them have access to the internet, and those who do have access to Duolingo, which they can use for free. So Duolingo has a very large space to grow their customer base. Of course, there are some risks here. User preferences can be shifted from gamified learning, or they can also be divided more between social media and fun platforms, which are of course still growing. Another risk is from competitors such as Google and Meta, which are creating their own products that you can just plug into your ear and they will translate all languages into whatever language you want. But as we have already said, Duolingo is not quite as a normal language application as many people think. However, there are some risks, so we will evaluate this segment as a B. And with this, we have completed the business analysis and now we move on to the fundamental analysis, which we will do with the help of the 9 pillars. First, we will take a look at the revenue analysis. Duolingo is doing very well, from 71 million in 2019 to 748 million in 2024, almost 1,000% increase in the past 5 years. The thing is that this growth rate has been decreasing, as you can see, from 130% to 55 to 47, 43 and 41% in 2024. If we quickly look at the analyst estimates, we will see that analysts predict that revenue will rise by only 23% annually in the next 4 years, which of course is not low growth, but it is not as much as historical growth. If we look at things from a quarterly perspective, we will see that revenue is growing very steadily, which investors like very much because then things are very easily predictable. And so we will evaluate pillar 1 as an A. Now we move to the second pillar, which is the net income analysis. As we can see, in the last few years the net income was negative, but in 2023 it was 60 million, then 89 million. And when we look at the quarterly view, we see that the net income is really growing very well and that it has not been negative for a long time. In the third quarter of 2025, the net income was very high due to a tax exemption that the company received, but in the fourth quarter it will probably return to about 40 to 50 million. However, the net income of the company is growing very well, and I believe that it will grow similarly into the future. So we will evaluate the pillar as such. And now we get to the third pillar, and here is something I really like about Duolingo, and that is that their free cash flow, as you can see, 273 million, is higher than their net income, and by a lot. This is absolutely amazing because free cash flow is what is used for everything around the business, for share buybacks, for payments of dividends, for paying down debt, and so on. So when a company has a higher free cash flow than their net income, it's nothing but good. And as we can see, free cash flow is growing very well. Quarterly, it is also growing very well. So we will also rate pillar 3 as an A. Now we get to the fourth pillar, which is the analysis of the profit margin. As we can see, the profit margin also rose from negative numbers to positive numbers. In 2023, it was 3%, in 2024, 12%. And the ROIC also rose to a positive number in 2024. From a quarterly point of view, we will see that the profit margin is still rising, but the ROIC, or return on invested capital, is still quite low, 2.5% in Q3 of 2025. I think that the profit margin could be higher, as well as the ROIC. So we will evaluate the fourth pillar not as an A, not as a C, but as a B. And now we get to the company's valuation. A lot of people actually think that Duolingo is currently undervalued, but that would not be entirely true. Although the company's PE ratio is only 18.25, as we said, at pillar 2, the reason for this is due to a large tax relief in the third quarter, which means that the PE ratio, which is calculated by taking the last 4 quarters, is now very low due to this one large number. To really find out if Duolingo is undervalued or overvalued, let's go to the charting page, where we can take a look at the non-GAAP ratio, which is the PE ratio that accounts for these one-time transactions, such as a tax exemption. As you can see, the GAAP ratio is now 53, which is very high. Although it is the lowest PE ratio the company has ever seen in its life, it is still very high. We can look at the valuation of the company accounting for its potential growth. We will select the PEG ratio, and as you can see, the value is still at 1.52. Ideally, it should be below 1, which would mean that the company is fairly valued against its growth. Now it is 1.52, so this indicates that the company is still quite expensive. Although it is the cheapest in its history, it is still expensive. For this reason, we will have to evaluate pillar 5 as a C. Now we get to pillar 6, which is actually the same situation. Price to free cash flow is now very low, but if we look at the last few quarters, it moves around between 40 and 50. So also quite high without this one tax exemption, which is a one-time thing. Therefore, we will also evaluate pillar 6 as a C. We will skip pillar 7 because it is the dividend analysis and Duolingo does not pay out any dividends, and we will arrive to the 8th pillar, which is the debt analysis. As you can see, in the last 5 years, Duolingo has gained a lot of long-term liabilities. But recently, all of them were paid off. If we take a look at the quarterly view, we will see that all of these liabilities were recently paid off. This was presumably done using cash and cash equivalents. As we can see now, long-term liabilities over the 5-year free cash flow negative dividends ratio is only at 0.20, which means that the company will not have any issue whatsoever paying off all their long-term liabilities with the free cash flow that they generate. And so we will evaluate pillar 8 as an A. And now we get to pillar 9, which is the share buybacks analysis. And here we can see that in the last 5 years, Duolingo has been selling its shares out. And in more established companies, in companies that are more stabilized like Google, Amazon, Meta, I would not like this. But in new companies like Duolingo, this doesn't really bother me at all, and the reason for this is that new companies often issue out shares to generate money for development, as they do not yet have enough from their operations. So this doesn't really bother me at all. On the other hand, they sell out only very little of their shares. They are trying not to lower their EPS and therefore not to lower their value for investors, which is very, very good. Normally, under normal circumstances, I would rate this pillar as a C or a D, but with Duolingo, we will rate this pillar as a B. With this, we have completed the 9-pillar analysis. We can move to the calculation of the intrinsic value. We will first calculate the intrinsic value using the Graham's formula, and here we have to predict the maximum earnings per share CAGR, medium, and the lowest earnings per share CAGR into the next 5 to 10 years. Now, to realistically predict these earnings per share CAGRs, we can have a look at the analyst estimates, and if we scroll down, we will see that the analysts predict a CAGR of 34% into the next 4 years. So returning to the intrinsic valuation page, I will plug in a maximum CAGR of 40%, medium I will go with 32%, and low I will go with 25%. This will give us an average of 32%. And when we scroll down, we can see that the intrinsic value will be to $100, which is 37% higher than the current trading price, which is a grade A. Now we can also have a look at the Peter Lynch model, which uses the same earnings per share estimates. And when I scroll down, we will actually input a different P ratio because this is the 5-year average. We'll input a P ratio of 45, and we will get an intrinsic value of $117, which now is 19.5% lower than the current trading price, therefore a grade of C. Now we can also have a look at the discounted cash flow model, and based on the historical growth and analyst estimates, I will predict the maximum free cash flow CAGR into the next 10 years plus of 25%. Medium, I will go with 17%, and lowest, I will go with 12%. Now for the discount rate, I will predict a maximum of 13%, medium I will go with 11%, and low I will go with 10%. And now when I scroll down, we will get an intrinsic value of $217, which is almost 50% higher than the current trading price, and therefore a grade A. Now moving to the multiples valuation, thinking about this, we'll actually skip the multiples valuation because, as we said, Duolingo is one-of-a-kind company. There is not really a company that does the same things as Duolingo does. And so we would normally also move to the dividend discount model, but Duolingo doesn't pay out any dividends. So we will jump straight to the ultimate valuation, where when we deselect the dividend discount model and the multiples valuation, we will get an ultimate intrinsic value of $178, which is 22% higher than the current trading price, therefore a B rating, which is essentially a buy rating. We will save the value and jump to the final rating, where we will add our overall analysis to our rating timeline. As you can see, the business analysis, intrinsic value, and the fundamental analysis were all added, And what this will allow us to do is track our analysis over time. So when we do analysis in 3 months, we will know where the business has moved. The final recommendation, as you can see, is a buy rating. The business grade is great, the fundamentals is very decent as well, and the intrinsic value, it seems like the company is about 20% undervalued. So I believe buying Duolingo right now would be a good idea. With that, I hope that you enjoyed the video. If you were wondering which tool I'm using to analyze stocks using this 3-step analysis model, the site is called Moneyssense. They are currently running a 7-day free trial, which doesn't require you to input your credit card information, so you have nothing to lose. Go check the website out, and I hope that you enjoyed the video. Make sure to leave a like and subscribe, and we will see each other in the next analysis video.